Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Intuit stock to see if it's one of the best dividend growth stocks for long-term investing. Personally, I like to look for the best businesses that have strong fundamentals, great management, great products and services, large economic moats, increasing earnings, and increasing free cash flows over time. Then I want to see if the business is undervalued now before I decide to invest in it. And if the business pays consistent dividends and increases dividends almost every year, this is a bonus. As always, I like to give you some context first. Intuit is most well known for its most important products, TurboTax, for people who want to file their own taxes, and QuickBooks for self-employed and small business owners that do not have large budgets to pay for expensive accounting software. Intuit also owns Mint, Credit Karma, MailChimp, and other professional tax software. In the past, most of Intuit's apps were desktop-based. Now Intuit has become a software as a service business. It has transitioned most of its software such as TurboTax and QuickBooks to the cloud. Many Intuit's products have become subscription-based. This is very important because this business model allows Intuit to have much more consistent and predictable revenue growth going forward. Obviously, past performance does not guarantee future results, but I still want to show you Intuit stock's past performance compared to the S&P 500 ETF here. Here you can see Intuit stock outperformed the S&P 500 substantially over the past 10 years. In the past 1.5 years, you can see Intuit stock did drop a lot after the Fed started raising interest rates aggressively to fight inflation. Obviously, this has impacted most tech stocks, including Intuit stock. So in this video, I'm going to talk about these topics to see if Intuit is one of the best dividend growth stocks for long-term investing. I will also talk about whether Intuit stock is undervalued now, Intuit's financial review and biggest risk, Intuit's biggest competitive advantage, Intuit's long-term growth prospects, and Intuit's stock valuation. At the end of the video, I will give you a quick stock portfolio update. I will talk about whether I will buy Intuit stock for long-term investing. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Intuit's biggest risk, I want to show you Intuit's financials here so you will know how Intuit earns most of its revenues. Intuit earns most revenues from its small business and self-employed business segment. This business sells QuickBooks software to self-employed and small businesses. The second biggest revenue is the consumer business. This business sells TurboTax software and assisted tax services to people who need to file their taxes. Credit Karma is not a large revenue contributor to Intuit yet. Professional tax business is also not a large revenue contributor to Intuit yet. We will focus on Intuit's two most important businesses, small business and self-employed business segment, and the consumer business segment in this video. These two business segments, specifically TurboTax and QuickBooks, contribute the most revenue and operating income to Intuit every year. According to these financials here, you can see around 90% of Intuit's total revenue is from service and other. This means most of Intuit's total revenue is coming from online software sales, such as TurboTax, and subscriptions such as QuickBooks Online. For example, around 80% of Intuit's small business and self-employed business segments revenue is subscription-based. In terms of operating margin, you can see Intuit has maintained its non-GAAP operating margin above 30% for many years, even after Intuit bought out Credit Karma for approximately $8.1 billion in fiscal 2021 and MailChimp for approximately $12 billion in fiscal 2022. Intuit's GAAP operating margin did decrease a lot in the past 3 years. This is because Intuit issued a large number of stocks to buy out Credit Karma and MailChimp. In my opinion, I believe Intuit overpaid Credit Karma and MailChimp using stocks. This is why Intuit's stock-based compensation expenses have increased a lot after buying out Credit Karma and MailChimp. Also, the non-GAAP operating margin is misleading here. This is because it adds back very large stock-based compensation expenses every year. So this can easily mislead many investors who are not familiar with accounting. I believe Intuit's GAAP operating margin margin is a much better representation of Intuit's actual operating margin, so we should focus on this GAAP operating margin going forward. Going forward, Intuit's management expects that the company's GAAP operating margin will improve over time. This is because they expect that their stock-based compensations will likely flatten over the next few years. They also expect that the company's operating income will grow at a faster rate than its revenue growth over the next several years. For the full fiscal year 2023, Intuit's revenue is expected to grow approximately 12% to 13% year over year. This is a very good revenue growth rate even in this high inflation market. GAAP operating income is expected to grow approximately 19% to 20% year over year. This means Intuit's GAAP operating margin is expected to be around 21.5% for the full fiscal year 2023. At the time of making this video, I believe Intuit has a very healthy balance sheet. For example, Intuit has around $4.37 billion of total cash and investments. In comparison, Intuit has around $7.1 billion of total debt and operating lease liabilities. $501 million is in short-term debt and $6.1 billion is in long-term debt. Intuit has nearly $4.3 billion of short-term cash and investments. This is more than enough to pay off the $501 million of short-term debt here. Of course, Intuit will use its future earnings to pay off the $6.1 billion of long-term debt over time. At the time of making this video, I believe Intuit's biggest risk is competition with the IRS free e-filing system. As of now, IRS is expected to release a new free e-filing tax system that competes directly with TurboTax. TurboTax is the most popular do-it-yourself tax filing software in the US. The IRS currently refers people seeking no-cost filing options to a consortium of companies that provide free e-filing for taxpayers below a certain income level. Though 70% of taxpayers qualify for those products, known collectively as IRS Free File, fewer than 3% of taxpayers use them. For a narrow range of taxpayers, industry giants Intuit, TurboTax, and H&R Block offer free products that the IRS does not officially endorse. In my opinion, I don't think IRS upcoming e-filing system will disrupt Intuit's TurboTax business. One reason is that free tax filing has been around for many years already. For example, if your adjusted gross income is $73,000 or less, you will likely qualify for free tax filing through one of the IRS tax filing partners. There are many companies such as Intuit and H&R Block that are already offering free do-it-yourself tax filing services. If you use TurboTax to file your taxes every year, you will likely stick with TurboTax instead of switching to another tax filing software because it is a lot of work to transfer your tax data from one platform to another platform. Also, there is always a learning curve whenever you use a new tax filing software. Filing taxes is always a lot of work for most people. For most people who only file taxes once a year, I don't think they want to go through the hassle to transfer their past tax data from TurboTax to the IRS upcoming e-filing system. In my opinion, it's a lot of work to learn a new tax filing software when the existing TurboTax software already works very well for many people in the US. Over the past 10 years, TurboTax has the largest market share in the do-it-yourself DIY tax filing market. For example, in fiscal 2022, TurboTax had 64% of the DIY market and nearly 29% of the total IRS tax filing market. The US tax filing market is expected to grow about 1% each year going forward. Here's an important fact about tax filing in the US. While roughly 70% of taxpayers qualify for free file, only 2% used it during the 2022 filing season, according to the National Taxpayer Advocates Annual Report to Congress. This shows that the IRS does not have a very good track record to convert more people to use its existing free tax filing services. In my opinion, I don't think IRS new e-filing system will make a difference to convert more people to use its new e-filing system. Here's another risk we should consider. If fewer people file taxes each year, this will impact TurboTax sales. For example, fewer people file taxes for the tax year 2022 compared to the tax year 2021. This is because people no longer receive pandemic-related stimulus checks and tax credits from the US government. This has impacted Intuit's TurboTax revenues in recent quarters. As long as there are more people filing taxes in the US each year, Intuit's TurboTax revenue will likely grow consistently over time. I believe the third biggest risk is this, which is affecting Intuit's total revenue growth. Intuit's Credit Karma business is largely dependent on the macroeconomy. At the time of making this video, Credit Karma's business is greatly impacted by high inflation, high interest rates, harder credit conditions in the US, and fewer loans offered by banking partners. These macro headwinds will likely last for at least one more year until the Fed starts lowering interest rates and until banks start easing their lending for consumer and businesses. Here you can see Credit Karma's revenue is expected to decrease 11% year over year for the full fiscal year 2023. Overall, Intuit expects that its revenue will grow by about 12% to 13% year over year in fiscal 2023. In my opinion, this shows that Intuit has a very resilient business model, especially its QuickBooks business and its TurboTax business. This from Morningstar. I want to show you the most important parts here that show Intuit has a strong economic moat because of TurboTax and QuickBooks' high switching costs and large network effects. We assign Intuit a wide moat rating derived from the significant switching costs and network effects in both its small business and self-employed segment and consumer segment. Intuit derives just over a half of its revenue from its small business and self-employed segment, which offers QuickBooks bookkeeping software for small business and self-employed customers, as well as their accountants. QuickBooks Online has 4.5 million users, and according to several sources, is estimated to have approximately 80% of the US market share for small businesses using financial software. We think that QuickBooks exhibits high switching costs given the regularity in bookkeeping and the pain of transferring a business accounting record as well as learning a new software to record entries. Switching bookkeeping software will also require relinking new booking software with various third-party apps, such as those for connecting point-of-sale software with bookkeeping software, or those that integrate payroll data. QuickBooks has noted that its software links to up to 700 applications. Within QuickBooks, retention rate of 79% is indicative of the hassle QuickBooks clients deem will ensue if they switched. While retention is low compared with enterprise software solutions as a whole, we think its retention is healthy for QuickBooks' small business customer base, which has significant churn simply due to a lack of small business survivorship. In other words, QuickBooks customers don't typically switch to an alternative software vendor, but instead shut down their businesses altogether. QuickBooks retention isn't unusual compared with other small business software providers' metrics, like Shopify's estimated retention of 75% or Xero's retention rate of over 80%. We think that QuickBooks merits a network effect because despite using accounting software, many small businesses opt to hire an accountant to go over their books that they track through software like QuickBooks. Since QuickBooks has the majority of the US market for small business accounting software, we think accountants have very little incentive to buy accounting software compatible with the minority of US small businesses, which we believe makes small business accountants more likely to opt for QuickBooks. QuickBooks also has partnerships with US universities in which about 50,000 students receive the software for free each year, perpetuating. In our view, a cycle in which QuickBooks is the most well-known small business accounting software, giving users more benefits from using the software as QuickBooks user base increases. These benefits are derived for both the accountant and the small business owner. For example, accountants will have a higher probability that their clients use the same software they do. By both having the same software, the accountant can see the client's books live rather than manually importing customer data into his or her software. We think these synergies are what lead Intuit partners like PricewaterhouseCoopers to do bulk QuickBooks order in the thousands of units in order to sell the software to their small business customers. Another reason users might hesitate to switch from QuickBooks is the need to retrain on other platforms for services already offered on QuickBooks, such as invoicing, payroll, assisted tax services, procurement services, and capital. We think that these options strengthen switching costs. Accounting for roughly 41% of revenue is Intuit's consumer offerings, including TurboTax software for do-it-yourself tax filing and Mint, a free platform in which consumers can connect their checking, savings, and mortgage accounts to get a holistic view of their financial health. We think that TurboTax exhibits high switching costs due to the stress of learning a new tax filing interface during an often short amount of time for many tax filers. According to the IRS, 20% to 25% of Americans put off filing their taxes until the last 2 weeks before April 15th. Apart from tax season stress, TurboTax Online users can access former tax returns, which will autofill current tax forms with basic information from the previous year, which we think supports high switching costs and which we believe is reflected in the software's 79% retention rate. Competitors like H&R Block, on the other hand, have retention rates near 73%. I want to talk about Intuit's long-term growth prospects here. In the most recent Investors Day event, Intuit's management gave this long-term annual revenue guidance. The consumer business revenue is expected to grow about 8% to 12% each year over the next several years. The small business and self-employed revenue is expected to grow about 15% to 20% each year over the next several years. And Credit Karma's revenue is expected to grow about 20% to 25% each year over the next several years. I think the Credit Karma's revenue growth is too optimistic here. The other businesses' expected annual revenue growth rates are much more reasonable. Historically, you can see that Intuit had very consistent revenue growth, operating income growth, diluted earnings per share (EPS) growth, free cash flow growth, and dividend per share growth almost every year. Intuit has also maintained very consistent free cash flow margins at around 30% for many years. Intuit is aiming to grow its businesses by focusing on these three areas. First, grow the core business, which includes TurboTax and QuickBooks, by connecting more customers and small business owners to more professional accountants, bookkeepers, and tax experts. Second, expand to more related services such as payments, payroll, and marketing services for small business owners, and offer more financial services and product recommendations such as personal loans, credit cards, mortgage, and insurance to consumers who use Credit Karma. Third, expand globally outside of the US. I'll share with you the most important growth strategies here that I think will likely increase Intuit's revenue and operating income growth going forward. Intuit expects that its consumer business or the TurboTax business revenue will grow by about 8% to 12% each year over the next several years. I think this is a reasonable revenue growth rate. I showed this to you earlier. TurboTax has the biggest market share in the do-it-yourself DIY tax filing market for many years already. I think TurboTax will likely maintain the biggest DIY market share for many years because it is very hard for people to switch to another tax filing software once they are used to TurboTax. Typically, you only need to file your taxes once a year. If you want to switch to another tax filing software, you will have to learn the new tax filing software, and it's a lot of work to transfer your past tax data to the new tax filing software. I think it's just too much hassle for most people to switch to the IRS new e-filing software or other competing DIY software. Going forward, as long as the number of people filing taxes continues to grow over time, more people will likely file their taxes using TurboTax. This means TurboTax revenue will likely grow gradually over time. In recent years, Intuit has expanded to TurboTax Live in addition to the regular do-it-yourself TurboTax software. This is a very important strategy because Intuit can earn more revenue per tax return filed if a customer chooses TurboTax premium services. For example, if you need help filing your taxes or if you need a tax professional to do your taxes for you, you will need to pay for TurboTax Assisted or full service. Going forward, I believe TurboTax revenue per return filed will grow over time because more people who are not confident filing their taxes will likely use these premium services. Intuit expects its small business and self-employed groups revenue will grow by about 15% to 20% each year over the next several years. I talked about this earlier. QuickBooks is a very sticky business for Intuit. This is because most small businesses, bookkeepers, and accountants are already using QuickBooks, so it's a lot easier if they use the same software. Based on what I know, it's very hard to switch to another accounting software once you're used to QuickBooks because you have to learn the new software, train your employees, and import your past data to the new software. At the same time, you want your bookkeeper or your accountant to use the same software. There are more than 700 apps already integrated with QuickBooks. This means it will be very hard for you to switch to another small business accounting software once you're used to the QuickBooks ecosystem. Of course, there are many other companies that also offer accounting software for small businesses. At the time of making this video, QuickBooks already has around 84% of the market share in small business accounting in the US. I think it will be very hard for other companies to compete with QuickBooks in the self-employed and small business market because of the large network effects and the high switching costs I just talked about. Going forward, Intuit is expanding its QuickBooks business by connecting more small business customers to professional accountants, bookkeepers, and tax accountants. Intuit is also expanding to more mid-sized businesses, which will likely generate more revenues. I believe all these premium services and related services for QuickBooks and TurboTax will increase Intuit's average revenue per customer or ARPC gradually over time. Most of Intuit's services are in the cloud and many of them are subscription-based. This means it's very easy for Intuit to increase its subscription prices gradually every year. At the time of making this video, most of Intuit's businesses are in the US. According to the most recent annual report, Intuit's international net revenue was only around 8% in fiscal 2022, 5% in fiscal 2021, and 4% in fiscal 2020. Intuit is expanding its QuickBooks business in Canada, the UK, and Australia. Intuit is also expanding its TurboTax business in Canada. So international expansion is another growth strategy for Intuit going forward. In terms of consensus revenue forecast, Wall Street analysts expect that Intuit's revenue will grow by about 11% to 14% each year over the next 5 years. In terms of EPS forecast, Wall Street analysts expect that Intuit's EPS will grow at much higher rates over the next 5 years. This is because Intuit's operating margin is expected to improve going forward. I want to show you how to calculate Intuit stock's intrinsic value here, so you will know when Intuit stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Intuit's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. I expect Intuit's free cash flow margin should be around 30% over the next 5 years. This is consistent with Intuit's free cash flow margin in the past 5 years. Based on the growth prospects I talked about earlier, I believe Intuit's total revenue will grow by about 11% to 13% each year over the next several years. This is consistent with the Wall Street analyst consensus revenue estimates. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we are forecasting Intuit's revenue will grow at a compound annual growth rate CAGR of 11% over the next 5 years. If we forecast Intuit's free cash flow over the next 5 years and discount the free cash flow to the present day, Intuit's intrinsic value should be around $135 billion for the entire company, or $477 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting Intuit's revenue will grow at a compound annual growth rate CAGR of 12% over the next 5 years. Then Intuit's intrinsic value should be around $141 billion for the entire company, or $498 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting Intuit's revenue will grow at a compound annual growth rate CAGR of 13% over the next 5 years. Then Intuit's intrinsic value should be around $147 billion for the entire company, or $519 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Intuit's intrinsic value should be around $498 per share. I also used the forward price to sales valuation model here to estimate Intuit's intrinsic value, which should be around $147 billion for the entire company, or $518 per share. If we take the average of both valuations here, Intuit's intrinsic value should be around $508 per share. Just to compare, Morningstar estimated Intuit's intrinsic value to be slightly lower at $503 per share. This means I believe Intuit stock is slightly undervalued at the time of making this video. So will I buy Intuit stock? Yes, I will likely buy more Intuit stocks going forward because I like Intuit's QuickBooks business and its TurboTax business. In my view, I believe both of them are very resilient businesses to macroeconomic headwinds. I believe they have large economic moats known as high switching costs and network effects. In fact, I already have Intuit stock in this growth stock portfolio here. I also have other portfolios that have almost the same stocks and the same investment strategy. I bought Intuit stock almost a month ago, right after the company released its earnings. Right now, I only have a very small position in Intuit. I call this a starter position. I will likely buy more Intuit shares gradually going forward, whenever it's undervalued. If you look at this portfolio here, you will notice that I like to invest in the largest tech companies such as Apple, Microsoft, Alphabet, Amazon, Visa, MasterCard, and Tesla. Personally, my strategy is to invest in the best businesses that are undervalued. Many of the best and most competitive companies are also the largest tech companies in the world. In my opinion, these are some of the best businesses in their industries. Most of them have very large economic moats that are very hard for competitors to copy. I bought many of them when they were much more undervalued before. This is why this portfolio is doing very well and it's outperforming the S&P 500. Before buying these companies, I always use my intrinsic value calculator to calculate their intrinsic business values, so I will know when they become undervalued, fairly valued, or overvalued. As of now, I believe many of the largest tech companies such as Apple, Microsoft, Nvidia, Meta, and AMD are likely overvalued, so I'm not planning to buy their stocks now. I will wait until they become undervalued before buying them again. At the time of making this video, I think many long tech companies are more fairly valued or undervalued, so I may diversify to other sectors that are more undervalued going forward. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.